Very good morning to you, Mr. Ramu. Great to have you on the show with us. Let's begin with the key question of whether the budget trade is now a bit redundant. I'm asking this because in the 4-5 days run up to the budget, the same set of stocks and the same buckets of stocks, those sectors have been buzzing for the last 6 to 8 months or so. Pre-election, pre-interim budget. Is that now a redundant trade? Have investors rotated out of it, or should they?
I feel, India is a fiscal constrained country as well. But what we are seeing is there's a bit of surplus we are getting from the tax side, as well as from RBI, a large dividend. Therefore, government will do a meaningful allocation across various sectors. I think both investment and consumption should be looked at. The focus in the previous budgets were more on the investment side. A bit of support to consumption will help us to take the growth further or consolidate the growth further at the current levels of 6 to 7% that we are seeing in India. Therefore, I think government is likely to do that. The trade towards budget, I think always, given the flows, it's likely to be skewed towards infrastructure, which seems to be played out. But broadly, we are not very negative on the market. There are still pockets of good opportunities to invest into. But yes, the infra play towards the budget seems to be at a much higher speed than what we have expected.
Madanagopal, this is also Samina joining in, and the recent rally has been phenomenal for the street. Calendar year, we're up 12%. Last 1 year returns up. I mean, we are the second best performing market in the world as we stand. Do you feel like we are borrowing returns from the past, and one trigger that could potentially disappoint is earnings? Do you feel earnings this quarter will be able to keep up with the sharp rally the markets have witnessed?
The broader participation, which has probably happened last year and following this year, due to narratives being very strong and the flow supporting it, as well as last year we had a good commodity tailwind, which helped most of the companies report good margins, which is going to be missing out from the second half of this year. So broadly, you will see earnings growth disappointing in a few of the sectors, which will reduce the earnings expectation. That can have some sort of leading to consolidation in the overall market. But if you really ask us, when we look at some of the long-term growth opportunities and specific stocks within those themes, we still feel if any investor takes a 3-year view and gets into the market even today, the likelihood of making a high teen sort of a return in the market looks possible. This is because of focus in one, the government's focus on the manufacturing, as well as the government's tax surplus leading to support to the growth further. I think overall, we feel that if you're stock selective, you still should not worry about the valuations in the market at this point of time. But if you are a passive investor investing in the indices, the best of the time is behind you. Better to move to an active investor and active fund manager. And I think being a part of the teams which are playing the India growth story, that should broadly help an investor to make a reasonable amount of money. But it has to be at least a 3-year view. It cannot be a short-term view in the market anymore.
Madanagopal, good morning, Neeraj here. You were constructive on IT, particularly ER&D, if I'm not wrong, since a while. Now, we've seen a bit of a rally post the Accenture numbers in all IT stocks, so much so that some of those stocks are trading at very high valuations, particularly the ER&D ones. Are you still constructive on them, and what's the view on IT services as well?
Put IT is still not, although we are long-term constructive, still not coming out of the hood, right? It is still, the large cap IT companies are not yet out of the earnings. We are not seeing a large earnings upgrade happening there. But what we see is some of the ER&D companies, once the discretionary spending comes back, can surprise on the growth front. Obviously, the valuation is rich. So we are not going too much aggressive on this positioning. We had certain gaps which we filled in. We are more positive on the mid-cap space here. And I think given what is happening in US in the artificial intelligence space and data center space and cloud, we feel that this space has potential to surprise on the growth front. That's where we are positioned there. But yes, obviously, the valuations are too rich. So we are going pretty slow on this, not too aggressive. We are still underweight on the IT sector. We will look for the right opportunities to enter. in this space. But whatever we have in the mid-cap ER&D space in this area.
Where are you constructive right now? What would be your top sectoral bet? I know you'll be bottoms up there, but if you can talk stocks, great. But otherwise, what's your top sectoral bet?
See, broadly, it flows through in the long-term call that India. We believe on the India growth story. I think India is set out with the support of what government is doing on the manufacturing side. We will look at somewhere closer to 6.5-7% sort of a growth on the real GDP side, and 10% to 11% sort of a nominal GDP. And if you really look at what we can play using this, one obviously manufacturing. In manufacturing, we are pretty constructive on the power side. As a country, we have lagged behind on the power capacity side in the last 2-3 years. Also on the transmission side, given the focus on the renewables, the dependency on the power transmission will increase substantially. Also, on the power generation side, both coal as well as the renewable will see capacity addition. So we feel that power sector will witness an unprecedented sort of an investment in the next decade. Because government has to meet both the climate change targets as well as the energy demand. So this is a very interesting area. And I think a lot of companies which left this space will come back. Profitability will come back in this space. Valuation is still not too high, except for certain pockets. But I think power sector is bound to go through a long-term story, and the investment is likely to come on an unprecedented level here. So this is one area where we are long-term positive. Second is, I think, given the affordability that has come, both on the renewable side as well as on the EV battery cost, you will see government should, and I hope in the budget a lot of focus comes in this area. You will see domestic manufacturing for solar cells and domestic manufacturing for EV battery will be areas where government should focus on. Because the affordability is there and we can scale up meaningfully in these areas. If you look at what is China doing in these areas, they are scaling up pretty fast and pretty huge. I think India is also consciously wants to keep the import on check on these areas. I think there's a big amount of J-curve sort of an impact coming in both these areas. So we have taken some specific positions looking at this long-term opportunity. This is again part of the manufacturing theme. We have always been positive on the financial space, particularly NBFC, small ticket, LAP, affordable housing, used vehicle finance. This is where our parent has grown and done a remarkable job over so many years. We feel that area looks pretty interesting with per capita income growing and more people becoming bankable. So we have companies which are positioned on these segments. We are positive overall on the retail credit, which has grown much superior than the overall GDP. But specific within the retail, we are interested in the segments that I mentioned, and very good opportunities are coming through at this point of time as the kind of the overall per capita income being much better in western south part of the country. So some of these very specific NBFCs operating in these areas are looking pretty interesting.
Gopal, while I understand the themes that you're betting on and we completely resonate with that, tell us 3 to 4 stocks that you think could be the next Titan over the next 5 to 10 years. In terms of ideas, while I get the sectors, 5 stocks that are in your model portfolio that you're highly, highly optimistic and bullish on.
I don't want to mention specific stock names, but because of the regulatory requirement. But what I would say is, I think if you're trying to play EV battery, there are 2 companies, right, which are mostly in lead acid battery, who have now transitioned very nicely and investing into the EV battery capacity. So you have to take a little long-term view on this. And I think we are talking about numbers like each of them adding some 6 gigawatt in the next 3 years. But if you look at what is happening in China, there are companies which are operating at 300 gigawatt each of them. And China's total capacity on EV battery could reach 3,000 gigawatt. And EV penetration in China is almost 50% at this point of time. So there needs to be a leap of faith. And if you look at it, this 6 gigawatt can turn out to be easily 20-25 gigawatt in 5 to 6 years time period. That is the kind of scalability potential that these stocks offer. Same as with some of the solar cell manufacturing companies. Today, we have solar modules which are being made in India. We are self-sufficient. But if we look at the solar cell manufacturing, there are hardly any capacity. We can count it could be closer to 3 gigawatt. and the demand for solar modules in India can touch even up to 25 gigawatt. And right now we are importing a lot of these cells. I think a transition to India at a reasonable price, we can domestically source these in India as well. So over the next 4 or 5 years, we will see a lot of this solar module manufacturers trying to become solar cell as well. And there is a good opportunity coming there in the IPO market, which are interesting there. Broadly, these are areas where the companies which are operating in these areas looks interesting to us. On the financial side, we feel that there is a south-based small ticket lab lender. This guy has grown from 2,000 crore book to 8,000 crore in a very short period, before COVID and after COVID. He can grow almost like 30-40% in the next 5-year time period, and take his book from 8,000 crore to almost like 35,000 crore. It's a company which does almost 8% ROA, and you can look at it easily closing at around 7% ROA in 5-year time period. So if you put these numbers and look at the current valuation, these are companies which can easily double in the next 3-year time period. So I can mention about similar company in affordable housing space, which is also growing at that kind of level. So broadly, we feel that within retail credit, if you focus on this in the small ticket areas, which is more on the used vehicle, affordable housing, and lab, pretty interesting companies are coming through. But obviously, we need to be very careful of how is the underwriting process. So we have been very selective on which stocks to look at, and that is what we have learned from our parent also. Being an NBFC, if you are in the right profitable segment which is growing, you make a really good return out of it over the long term, which is what Bajaj Finance did for a long period of time. So we're looking for next Bajaj Finance out of these companies. On the consumer side, I think the sector itself is not doing well at this point of time. But we have been lucky in getting some of the stocks right there, like Zomato, Trent, and Titan. We still feel some of these ideas have potential to outgrow FMCG space,
Right.
and are available at a reasonable valuation, we feel.
Okay, so Zomato and Trent still available at a reasonable valuation, you believe. Thank you so much for joining us today, and great to speak to you on the show, Mr. Raju.